you're an accountant, you see this stuff go on with this new scandal with the IRS. Do you get a million phone calls about it?
I don't really get a lot of phone calls about that. Usually I get the call about somebody's in trouble. So,
well, I mean, so what is your take? I mean, when you see these types of things go on where apparently the IRS is targeting certain people for audits or whatnot, what is your take on it?
Well, I see a different view of the IRS than most people, obviously, because I deal with them day in and day out. I do think that most of the IRS agents and revenue officers and personnel are pretty upstanding citizens. Are there the rogues and the retaliators and the politically motivated? Absolutely, just like there are in any other cross-section of society. And unfortunately, I've seen that within the IRS in a few cases. Right now I'm representing a tax preparer, actually, a CPA, who during the conduction of while they were doing an examination on a taxpayer, the revenue officer retaliated against her and hit her with some large penalties just because her job, she was kind of exposed for incompetency and some other things. So she kind of retaliated against the tax preparer in this case. So,
we see it sometimes, I guess, also in the mortgage industry, where sometimes people feel the need to prove the value, their own value, and they do that by taking hard lines.
Yeah.
Is that, you kind of see that.
Well, I think that's the case sometimes.
Top,
I'll give you another example. I dealt with a manager within the IRS, and we were dealing on a particularly difficult case. We really just wanted to work it out, and the guy finally would not abide by the law, and I called him on it, and he said, well, so sue me. And like you say, it was kind of like, hey, I'm trying to save face here, and, I don't care what the law says. You have to prove it. And I don't think it happens a lot, at least in my experience with the IRS. Does it happen? Yes, but, we can look, again, at a cross-section of society. There's always going to be an element of society that is going to be less than circumspect in their dealings.
Sure. So when you start looking at the IRS now, and of course, people just paid their taxes. People start worrying about audits. People maybe at this point in time are wondering who they gave deductions to or gave donations to that got the deductions. They might have put them on the hot list. Right. But what are some things that you're seeing the IRS really look at now, maybe more than before?
I think that's a great question. Right now, particularly because of what we've come through, I think two real hot buttons for them is one, and we've talked about it in the past, is just delinquent returns, people who haven't, been keeping up on their tax filings. And a large reason for that actually is because they've gotten in trouble. And I guess lately we've seen just a tremendous number of canceled debts. So things that come on what we call a Form 1099-C, say a foreclosure or a deed in lieu of foreclosure, maybe a loan modification. We're just seeing a tremendous amount of those as a result of largely unfiled tax returns or people now just getting around to having to deal with it. And banks are still unloading property. And so in some cases where a taxpayer abandoned a property, they didn't have to deal with the tax consequences until it actually went through a foreclosure procedure. Mm-hmm. Now we have to deal with the canceled debt. So cancellation of indebtedness is becoming a very hot issue. And I would say right now, what I've seen and observed, you have a high percentage of those tax returns being examined. My experience is about 1 out of 3.
Wow.
That's a high number.
Now, when you say examined, what does that mean?
Audited.
Audited?
Mm-hmm. Yeah. The IRS is going in and looking at it. And the reason is you're talking about large numbers. If somebody had a home foreclosed for $600,000 and, so let's say the loan value is $600,000 and when they issued the 1099-C, the fair market value was $400,000. You're talking about $200,000 of ordinary income, not counting any other possible income tax ramifications, which there are others. Mm-hmm. And in those circumstances, that's a lot of money.
Sure.
So you can imagine the IRS wants to make sure, A, it's done right.
Right.
And then B, have every opportunity to grab additional income tax if it's possible.
That is their job at the end of the day, right?
And there are a lot of returns that they're finding are done wrong.
Mm-hmm.
There are quite a number of professionals, even in my industry, who don't understand the provisions of, I'll call it Section 108, which is the section of the Internal Revenue Code that deals with canceled debt.
Do you tend to think that a lot of times when people are going through this process, I mean, they end up with potentially canceled debt and maybe don't even understand what the ramifications are down the road? Because it seems to me, and this is coming from somebody who's pretty in tune with, I talk to you all the time, I talk to tons of people in the financial world all the time, and it still seems to me that so much of the tax code is just too freaking confusing. And there's no clear-cut lines, and there's no clear-cut way to even try to do things the right way. I guess you can try, and then you talk about these audits, and sometimes you're going, well, I did exactly what I thought I was supposed to do, and here we are now. I'm in trouble for something that I thought I did right. It's like going to school sometimes and thinking you aced a paper only to find out you read the wrong book or something.
Yeah, I think that's very true. In fact, a lot of people hear, well, I understand that they extended the provision so that if I had a foreclosure or a short sale or some kind of a loan modification before the end of 2013, it was before the end of 2012 that they extended it, that I was okay. Yes and no.
Sure.
And the reason is people get in trouble on that is, A, it only relates to a principal mortgage, your primary home. Mm-hmm. Yeah. And so if it's not your primary residence, you're out of luck on that one. The second is if it's non-acquisition indebtedness. Now, that's a legal term.
Well, it's when people pull a bunch of money out of their house and in a refinance.
Exactly, except that there is a circumstance. It's kind of an unknown one out there. But if you pulled out money in a cash-out refi, because you're divorcing a spouse to pay them equity in their house, you get to add that portion of the equity that you paid to that former spouse to your acquisition indebtedness. So you can actually do a cash-out refi and add to your acquisition indebtedness. It's a pretty unusual
You just have to get
twist,
divorced.
But yeah.
Probably cheaper to do it that way than other ways, huh?
And I had a client that benefited, when we got through asking all the questions. One of the questions was, when you refi, did you do any of this because of a divorce? Well, yes, I had to pay my former spouse the equity. Oh, well, that changes everything.
Funny.
And it benefited her. Mm-hmm.
Sure. John, do you tend to think that as people go through this debt, I mean, what are some of the biggest ways people are getting in trouble?
Well, you mentioned one is they assume, hey, the cash out refi doesn't really cause them problems. So the non-acquisition indebtedness is a problem. I have a situation that we dealt with recently where you have estranged spouses, they divorced. And prior to the divorce, all the property was held in one spouse's name. They were a real estate investor. And so now, years later, they have to deal with the tax returns because they've sort of ignored all of that.
Sure.
And so dealing with another CPA, the other CPA said, well, why don't we just file separate returns? And, she just takes her income, he takes hers, or he takes his. I said that works in a lot of the United States, except that they lived in a community property state. So states like Washington, California, Arizona, they're all community property states, and she technically would have to take half the income. So sometimes the acts of spouses in community property states can get us into trouble, and Washington is. So that's one of those places. The other is misunderstanding the law. You have things like I had a CPA say, well, there's no problem because they were insolvent. And I said, that works, except that in this case, insolvency provision under Section 108 only applies to the extent of insolvency. So what I mean by that is, let's say you are insolvent to the tune of $50,000, but your cancellation of debt is $200,000. Well, you can only claim $50,000 exclusion, so you're taxed on $150,000. The difference. So it's kind of not understanding the law, and that all surfaces under exam or audit.
Sure. John, we just have about a minute left. So now that people have kind of filed their tax returns, hopefully, or a lot of people have or whatnot, how does somebody realize if they're going to get audited or not? I mean, is there because everybody files, and I think everybody, and there's a little bird on their shoulder going, ha ha ha, I still might come back and get you no matter what you do. I mean, I guess now that the paperwork's been filed, how do you even get notified? How does that work?
You receive a notice initially of an exam if they're going to do a full audit. Most audits are actually correspondence audits. They're done, say, at a service center in Ogden or something like that. And if any questions surface, they'll send a letter. It's called a CP 2000. And the letter will say, hey, we've got some questions on this. That actually happened in the case of a cancellation of debt income on one of my clients. And they just didn't read the return. In fact, I showed it to my two partners, and we all laughed because it clearly reflected a lack of knowledge on the services side. And so we wrote a polite as polite as possible letter in response, and that settled things. But I guess I would say if you get a CP 2000 letter or some kind of a notice saying, hey, we want to examine your return, or we have examined it here at the Ogden Service Center, and we have questions about these things, best thing to do is not ignore that because the clock is already ticking. In this case, in a CP 2000 letter, you typically have 30 days to respond. If you don't respond, then you have to resolve it through the tax court oftentimes. It depends on what the letter says, but in my experience, you just don't want to ignore those things.
So you get the letter, make it happen.
Yeah, exactly.